You may want to pay attention to this. Here are the 2 pieces of advice Warren Buffett has for all young investors. In an interview earlier this week, Warren Buffett, the greatest investor of all time, said that number 1 is to understand accounting. He said it has to be like a language to you. You have to understand what you're reading. And he's referring to a company's balance sheet, income statement, and cash flow statements. He said that he taught most of these things to himself, and you can too. And his second piece of advice was to have the attitude that you're buying a business, and that you're not just buying something that wiggles around on the chart, or that has resistance zones, or 200-day moving average, or that you buy puts or calls or anything like that. Day trading. Let me know in the comment section if you want me to cover any of these financial statements.
Best investment advice from old rich people. Start now. One of the biggest regrets from older successful people is that they didn't start sooner. If you make your financial freedom a priority, it will become an inevitability in the future.
Here's my best advice for young people wanting to invest. Stop trying to turn $100 into $1 million. Instead of trying to invest money, invest your time. Take an hour a day. Read a book, learn a new skill, create content, build systems. Invest your time wisely, because the more you learn now, the more you'll earn later.
What was that one best financial advice that you've heard that had a very big impact in your life? I'll start. For me, it was that my finance teacher once said to me that before you actually invest or start a business, you should have an emergency fund and insurance first. Because that way, you won't have to think about too much risks because you have a safety net. Because if you have an emergency fund, you can allow yourself to not get salaries in the first 6 to 12 months of your business. And if you get sick or any emergencies, you have your insurance to protect you and your family members as well. So before you risk it all in a business or a startup, have yourself protected first by insurance and having an emergency fund. It also follows if you want to start a farm.
Nope. 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 Yep.
My best piece of advice for any investor starting in the stock market is stop trying to get rich quick. The stock market is not a get rich quick scheme. When starting off, your focus should be building a long-term portfolio before getting to anything super risky. And that means avoiding penny stocks and avoiding options. So my recommendation when you're starting off is buy an ETF, either ZSP if you're Canadian or VOO if you're from the US. And if you want to open up a free brokerage account, I have a link in my bio for Canadians. You get $10 when you sign up with Wealth Simple.
What's the best piece of investment advice you've ever received? I'll go first. Compounding interest is the 8th wonder of the world. And you know what compounds the fastest? Investment in yourself. Get it.
If you're interested in financial matters, A, you've got to have something to work with. I mean, I was fortunate in that respect because my dad paid for my education. If he hadn't, I probably wouldn't have become educated if I had to pay for it myself. But so I was able to save $10,000 by the time I was 21. And, that was a huge head start. If I hadn't been able to do that, and my first child came along when I was 22, so I mean the family, it's much easier to save it in those teenage years if you're lucky enough to be in a family where you don't have, where your parents are taking care of your financial obligations. Every dollar then is worth making $10 or $20 later on. And so if you are interested in financial matters, getting a stake early is very useful, and getting knowledge early is very useful. So, I would say you're well on the way if at 11 you're even interested in coming to a meeting like this. And I would, if that interest is maintained, I would read financial publications. I would read whatever was of interest to me. I'd be curious about how the businesses around the town of Kearney operated. I would. To the extent that you can get people to talk to you, and people usually like to talk, learn about who's got good businesses in Kearney and why they're good businesses, and learn about the businesses that went out of business and why they went out of business, and just keep accumulating knowledge. That's one of the beauties of the business that Charlie and I are in, is that everything is cumulative. The stuff I learned when I was 20 is useful today. Not necessarily the same way and not necessarily every day, but it's useful. So you're building a database in your mind that is going to pay off over time. But you have to have a little money to work with. So there's nothing like getting a few dollars ahead. Stay away from credit cards, and you can have a lot of fun if your mind goes along that track.
This is a positive. The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks. And this is the kind of stock people like to own. This is the kind of company people adore owning. This is a relatively simple company. They make a very narrow, easy to understand product. They make a 1 megabit SRAM, CMOS, bipolar risk, floating point, data I/O array processor with an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip with a plasma matrix vacuum fluorescent display. It has a 16-bit dual memory. It has a Unix operating system, 4 whetstone megaflop polysilicon emitter, a high bandwidth, that's very important, 6 gigahertz, double metallization communication protocol, an asynchronous backward compatibility, peripheral bus architecture, 4-wave interleave memory, a token ring interchange backplane, and it does it in 15 nanoseconds of capability. Now, if you own a piece of crap like that, you will never make money. Never. Somebody will come along with more whetstones or less whetstones or a bigger megaflop or a smaller megaflop. You won't have the foggiest idea what's happened. And people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor, you're not sure this Walmart can make it. You want to check, you see them operate in small towns, you're afraid they can only make it in 7 or 8 states, you want to wait till they go to more states, you keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money, but you could have waited 10 years after Walmart went public and made over 30 times your money.
My mother, I was born in Montreal, worked at a company called Kitty's Togs, And she used to come home and tell my brother and I, because they'd pay them every week on Thursday morning, she'd always invest a third of her paycheck into Bell bonds with coupons. She'd always say to me, boys, never spend the principal, just the interest. And never, ever, ever, ever buy a security that doesn't pay a dividend.
Right.
And, you know, back in those days, stocks paid higher dividends than the bonds. So example, you know, Bell Canada had a 6% yield on its 5-year paper, its bonds. The stock yielded 7 to entice people to take the risk to own an equity. And we got lost somewhere between the 50s and the 60s and 70s. And we actually thought that it was a good investment to buy a stock that didn't pay a dividend, which to me is insane. So anyways, I wanted to found a firm on that, my mother's basic concept, because, you know, she died a few years ago and I was executive for her estate, and I looked at her portfolio, which she never shared with anybody, but 40 years compounded dividends and bonds. You know, 73% of the market's returns over the last 40 years came from dividends, not capital appreciation. And she knew that intuitively. So that's how we built the foundation of O'Leary Funds. We listened to Mom. We don't own a single security that doesn't pay a dividend. I will never buy a stock in my life that doesn't pay a dividend. If it's not returning cash to me, it's a speculation. And if a manager can't send me cash, I'm not interested.
So that was good information there from those 3 investors. And, you know, they covered quite a bit, some different areas and that sort of thing. But what I would add to it is you also want to learn how to invest in yourself, right? You can do this by, let's say you want to start off in real estate or stocks. What you want to do is you want to start reading books. You want to take some courses, maybe read blogs, follow people on YouTube and that sort of thing, just to learn. You want to start immersing yourself a little bit every day into this information that's out there. So just follow a couple people you like and you trust. And for myself, what I did was, when I wanted to start investing in the stock market, I just studied the best, right? Who's the Michael Jordan of investing? That was my kind of thought process. So I started to learn about Warren Buffett, Peter Lynch, Charlie Munger, all these type of guys, right? So I just studied them, read their books, you know, watched their videos and what they talk about and what they look for investments. And then I just took all that information, I just kind of formulated it into something that I was comfortable doing, right? So I took the best out of each one of those guys and just kind of said, okay, this is what I want to do, but I want to tweak it a little bit, right? So so those are just some thoughts to start. You don't need to start big. Just start off with a little bit, especially in the stock market, you know, $500, $1,000, just get started. You can maybe buy an index just to get going, and then you can start to feel comfortable with it, and then pick some individual stocks after if you like to do that. Okay, the other thing you may want to invest in is starting your own business. This is important too, especially if you're working a full-time job. It's good to start up maybe a side hustle or save up a bit of money and do some other type of business on the side, because, you know, one of the major things that's not really talked about in personal finance too much is gaining more income, right? So people just work their jobs and then they take some money and they invest in that sort of thing. But the way you get really far ahead fast is you generate more income and you use that money to invest. All right, so it just accelerates everything much better. The other thing, the other lesson that the other point I would bring up to you guys is compound interest. Okay, compound interest is really important, especially for your investments. I mean, first of all, your investments, you put money into the stock market, put it in there a long time, invest with great companies, or invest in really good real estate, and it will compound over time. So most people know that information, but you also got to be careful with some other compounding in your life, especially what I think about is your health. Your health is your most important investment, in my opinion. So you want to always be treating your body as good as possible. And you know, compound works both ways, right? If you don't put good food in your body or treat it well, over time it's going to start to break down on you. So keep that in mind. You want to invest for the long term, and you want your body to last for the long term as well, right? And then the other thing with compounding is relationships. You know, relationships are really important. Your friendships, relationship with your family, co-workers, that sort of thing. So it's really good to invest time and energy to make sure you have the best relationships possible, because, you know, again, that with your health are much more important than the money. But if you can do all three, then it's a fantastic combo, right? So that's what I want to add to these other guys, but hopefully that helps. And yeah, if you like the information, it would be great if you could subscribe, hit the subscribe button, and we'll see you on the next video.